Oil is down 29% from its peak, the biggest supply shock in history, and the price is falling. Here's why that's not the story you think it is. 1973, Arab oil embargo, 8% of global supply removed. Oil prices went up 300%. 1979, Iranian revolution, 5% of supply gone. Prices doubled. 2026, Hormuz closes, 10% of global supply disrupted, the biggest shock ever. Peak price increase, 92%, and now it's coming back down. That gap between what history says should have happened and what actually happened is explained by 4 buffers. Each one is finite. Each one is running out. Welcome to Crude Oil Desk. Every week we track where oil is flowing, what it costs, and what it means. Oil peaked at $138 on April 7th. It's now trading below $100. The price says the crisis is easing. The physical market says the opposite. Today we explain the gap. 4 things are keeping oil below $200. None of them last forever. Buffer 1. China. Beijing slashed imports 40% in May. They're drawing on a 1.4 billion barrel strategic reserve. That removes a massive chunk of global demand. But the moment China starts restocking, that buffer reverses into demand pressure. Buffer 2. The United States. US exports are up 2 million barrels a day above last year. The SPR released 172 million barrels, but US inventories are now at their lowest in more than 2 decades. As a senior PIMCO manager put it, we're not capable of sustaining these exports. 2 more buffers, both even more fragile. The oil price is down 29% from its peak. The global draw rate just hit an estimated 10.8 million barrels a day. Those 2 facts cannot both be true for much longer. Buffer 3. Hormuz. 2 to 3 commercial ships a day are transiting the strait, down from around 100 before the war. That trickle isn't a buffer, it's a news story. For it to matter, analysts say you need 20 ships a day for a full week. We're not close. Buffer 4. Peace deal speculation. Every time Trump signals a deal is coming, traders unwind positions and the price drops. But each false dawn makes the next announcement less effective. This buffer only works while the market believes it. Here's the real problem. The draw rate in March was 5.3 million barrels a day. April, 8.6. June estimate, 10.8. The inventory system is tightening faster every month, while the price is lower than it was in April. Those 2 lines cannot diverge indefinitely. 1 billion barrels is missing from the global system. 4 finite workarounds are hiding that fact. The question isn't why oil isn't at 200. The question is what happens when the workarounds run out. The numbers to hold on to: Brent pre-war, 71.90. Brent peak, 138.21. Brent June 1st, 98.29. Supply disrupted, more than 10 million barrels a day. Weekly inventory draw, 70 to 80 million barrels, according to PIMCO. China imports in May, 40% below last year. US oil inventories, lowest in more than 2 decades. 4 things to watch. 1. Cushing inventories, every Wednesday at EIA. When Cushing hits operational minimum, US export capacity is physically constrained. 2. China June import data. If imports start recovering, Buffer 1 reverses. 3. Hormuz daily ship count. Watch for any sustained move above 10 per day. 4. US-Iran talks. A credible ceasefire framework, even without full reopening, would send Brent to 75 rapidly. That is the one buffer that can reprice the market overnight. That's issue 7 of Crude Oil Desk. If this was useful, subscribe. Free, weekly, no noise. Link in the description. We'll be watching those 4 signals closely.